Treasury yields end the week lower, actually their lowest weekly settle since November 1st. Recall in that time period we saw yields get up very close to 2%, and now we're back down in just a matter of weeks. Market has made a bit of a turnaround. Obviously it's all about China, all about trade, maybe a dab of Fed and dab of economic data in there, but really the macro picture looks very much like it did 2 weeks ago. With, I think there's a lot of longs that got out of the market that are now back in. I think Fed policy is pretty much on pace for no cuts at the end of this year, possibly one in 2020, maybe mid-year. And the whole China trade thing comes and goes like the wind. We hear China yes, China no, China yes, China no. The bond market hasn't really overreacted to that, but I think the macro picture suggests that there is a little more caution now as to when that might happen. The stock market clearly is ignoring the bad news China trade deal talks, but is accepting and trading off of the good. And I think at this point that is going to continue to happen until maybe there's either a hiccup and it doesn't happen, or they can get pen to paper. At this point, it sounds like it's not going to happen until end of the year, possibly early first quarter of next year. But it still is on pace to happen. Market volatility, yeah, it's way down there. We see it trading at those levels we saw prior to the first Fed cut back in January or back in July. And I think at this point, it's kind of holding steady. We're not seeing it plummet to new lows. We're not seeing it crater. I think there is some cautious optimism in the market that while I think things are good right now, we're heading into year end, there could be a little bit of a money play here. There also could be some kind of a hiccup as we get into 2020 if the economic data and what's happening with the Fed in the short end of the Treasury curve. So there are some things that are the reasons why you would see volatility maybe not going any lower than it already is. 4% is a pretty low level on the scale, and the fact that we've kind of held there several times on these down moves means that we're probably going to hold there and sort of trade the sideways trade in volatility, even if yields continue lower. Remember, yields need to see a breakout north of 185 or south of 165, I think, to see any real spike in yields. But that doesn't mean they can't just trade sideways for quite some time, and that's what we've been seeing. So volatility holding steady, yields kind of dripping lower. Well, what do we have next week? Well, we have a holiday week next week. We have a handful of pieces of data coming out. I think the markets will be relatively quiet. We should hold a pretty tight range unless, of course, there's something out of left field. And that leads us into the first 2 weeks of December, where we do have a very busy calendar between NATO and OPEC. We've got a Fed meeting. We've got an ECB meeting. Don't forget Ms. Lagarde will be taking the gavel for the first time there. We have UK elections that will be coming up that are right now seem very much tied to market trade. And there's a lot of uncertainty around all those. Throw in there maybe an unemployment report in the first week of December. And there's a lot to trade off of and a lot of anticipation that's going to be going on. So I think next week may be kind of a slow week that will build into a huge week for actually a huge first 2 weeks of December with all that data. So right now the Treasury market getting close to that midpoint of that meaty part of the old range, that 175. We're just above it right now. But it seems the market is trading cautiously optimistic as we head into the weekend. Look for a quiet trade next week, but things will pick up very quickly in the first 2 weeks of December.